Hello. Today we're going to talk about understanding your options for real estate funding. Basically, we have three options. Your first in buying a home is conventional lending. Conventional lending, of course, it requires taxes. It requires a reasonably good credit score in today's market. I'm going to say 620 and above. Additionally, it requires a down payment. Depending on the property, it could be 3% all the way up to 20% if it's multiple properties. Again, it takes the amount down. Make sure you have an appropriate down payment. And additionally, it's the value of the property. Of course, if you're buying, it has to meet the right value for it to be the right deal to do conventional lending. Now, just on a whole other side of the spectrum, we have hard money lending. Hard money lending, it really has a personal touch to it, because in the hard money configuration, for one, they got to feel confident in lending you money that they can get their money back. That's the first thing. So there is a personal touch to it. But additionally, hard money lending can have higher interest rates. It's not going to be as low as traditional funding, traditional lending with real estate. Now, with hard money lending, they typically like the ARV of the property to be appropriate. Let me give you an example. If you buy the property $50,000, or if you have a property that's worth $50,000, and in that property it may require some repairs. Say if your repairs are $50,000. Now the entire amount that you owe on this property is $100,000. Now, preferably hard money lending, they'd like that property to be worth at least $200,000 or somewhere in that area. So again, they like to be at from a 50% after repair value at the maximum, or at the minimum 75% of the actual repair value of the property. So again, if the property is worth $100,000, hard money lending, the most they like out on it is $50,000. In the highest case scenario, $75,000. Now again, hard money, it comes with higher interest rates and shorter term in lending. So in most cases, you won't get a 30-year mortgage for a hard money lending configuration. They typically like to lend from 6 months to maybe an 18-month period. And that is the maximum term in most hard money lending configurations. Now we're going to talk about option 3. This is more, I'm going to call it mid lending. Now this bank, what they like, of course, they like a good person, because it still has a personal touch to it, because they want to know who they lend to has the ability to pay back and understand what they're doing. Again, the credit score is very important to this mid lender. They typically like 680 to 700 credit scores. And they also, is very important in their configuration, is your income requirement. They like to have very strong income. So meaning, they may not want you to come out and have a W-2 type of job or taxes and all these other things, but then they'd like you to have bank statements. They may have 2 months to 24 months requirements in bank statements. But the third thing that's very important in this mid bank is the property evaluation. They like to stay again within 50% of the property valuation to 75% LTV. Again, if you loan $100,000 out in the mid bank, the most they like you to be is 75% of that value. Now again, that is the third option you have to maximize your funding in real estate. The mid bank, again, just to mention about them, they can fund from the 6 months to 18 months on the short-term configuration, and additionally, they can do the 30-year funding. Now, in their configuration, they're usually a point or two higher, maybe even up to 3 points higher than conventional lending, because conventional lending, again, lacks taxes, and they have very little personal feel about how you're going to purchase this property. Conventional lenders, They look at all the numbers typically. Now, when we talk about mid lenders, this is unconventional lending. They really look at your character and the creativeness of the project to be able to come up with a solution to maximize the lending for you. Now, again, to find out more about this, please subscribe to our channel.